Hi, my name's Adam. Welcome to the channel. Thanks for joining us in video 2 of our mini-series on what happens to your RSP in Canada when you retire. In this video, we're going to talk about RRIF minimums as well as the pension income tax credit. So we're going to cover off both of those topics in today's video in our mini-series. If you haven't already subscribed to the channel, make sure to do so. Hit the subscribe button below as well as the notification bell, and you'll get a notification every single day this week when we post a new video. And going forward, every Tuesday and Friday, we release a brand new video. So 2 videos every single week on financial, retirement, estate, and tax planning for Canadians. And as always, if you have any comments or questions, please put them below. We'd love to, communicate with you, connect with you on this platform. So if you have questions about, converting to a RRIF or RRIF minimums or any of the pension income tax credit stuff that we talk about today, leave a comment below, leave a question below, and we'll make sure to answer them personally for you. So jumping into RRIF minimum. So for a retirement income fund, once you convert from an RSP to a RRIF, there's a minimum amount that you have to take out every year, and that depends on your age. So depending on your age, there's a percentage of the account value at the end of the previous year, so December 31st, that will determine the amount that you need to take out the following calendar year. So again, the percentage is based on your age, and we'll put a link below so you can click on the link, find your age, and see the exact percentage that you're gonna have to take out of your RRIF. Now remember that there's no RRIF maximum. So only in a locked-in RRIF there would be a maximum cap, but in a regular RRIF there's no maximum. So the minimum you have to take out, and again, there's no withholding tax. If you remember from yesterday's video, the minimum RRIF amount that you take out or have to take out, no withholding tax. Anything above that, there's going to be a withholding tax. But remember, your minimum RRIF amount is still taxable income to you. So be prepared for that come tax time. You may owe a bit of money in tax. Alternatively, that minimum amount that there's no withholding tax, you can request from your financial institution to have them withhold tax. And we do recommend this. Anywhere from 10 to 20% is probably the ballpark for most Canadians in retirement. One other thing that we see people get caught up with RRIF minimums in retirement is when you have multiple RRIF accounts, which you're allowed. You can have, a RRIF account at a bank, at a credit union, at an independent financial advisor. Doesn't matter. You can have multiple RRIF accounts, but the minimum is based on per account. So if you have $100,000 here and 100 here and 100 here, and your minimum amount is, let's say, 4%. So you have to take out $12,000 total. You can't take it out of just one and leave the others. You have to take out a minimum of 4 from each individual RRIF. So keep that in mind. That's why we always recommend, as you get closer to retirement, to start putting a plan in place and really consolidating your accounts so that when you retire, it's a more streamlined income flow. Putting your assets together in one financial institution or, under one investment firm isn't, not diversifying. You can have great diversification within one investment firm. Okay, so it gets complicated when you have accounts everywhere. So when you look at your RRIF minimums that you have to take out, definitely having one RRIF account or maybe 2 at most is going to simplify your life a whole lot come retirement. One other catch or tip, when you convert your RSP to a RRIF, on the conversion form or on the application form for the RRIF, it's going to ask you, are you basing your RRIF minimums on your age or your spouse or common law partner's age? Okay, so if your spouse or common law partner is younger than you, you can actually base your minimums off of their age. So especially when you get a bit of an age gap, 5 or 10 years, that can be beneficial because let's say you're 71 and you're forced to convert your RSP to a RRIF and your spouse is only 61. And you don't really need the RRIF income. If you base it off of your spouse's age, the required minimum is much lower than it would be for yourself. So considering base your minimum off of your spouse's age if there's a bit of an age gap, and especially if you don't need the taxable income. And one last tip on RRIF minimums. Remember I mentioned in yesterday's video, you don't have to convert all of your RSP to a RRIF at one time until you hit 71. So if you're 65 and you want to start drawing a bit of an income and you have $500,000 in an RSP, you can move 50,000, 100,000, whatever number you want to a RRIF to start drawing a bit of income out. So remember, it doesn't have to be the whole amount. because you may not want to do the whole amount because your RRIF minimum might be higher than you want. It may create a larger taxable income, old age security clawback, a bunch of issues. So, make sure that if you need some income out of there, but you don't want to, drive the whole amount, you can convert part of your RSP to a RRIF to keep that minimum RRIF withdrawal a bit lower than it would be otherwise. So the last thing here is the pension income tax credit. So once you hit 65, you can have 2,000 of pensionable income to you can earn a tax credit. So you can get about 15% back on a tax credit. What this means is there's only certain types of income that qualify. A RRIF is one of them. So once you hit 65, if you have no pensionable income, and again, we'll put a link below on what qualifies for this pension income tax credit. If you can't check off any of the other criteria, then maybe your RSP to a RRIF conversion makes the most sense. And we've done this for clients where they don't need the income, but they don't have any other income that qualifies for this tax credit. So we convert $2,000 every year from their RSP to a RRIF and then pull it out of the RRIF, because RRIF income qualifies for this tax credit. RRSP income does not qualify. So if you're not getting that pension income tax credit from other income sources, once you hit 65, make sure to convert at least $2,000 per person every single year to a RRIF and then withdraw it to get that pension income tax credit. So that's one tax planning strategy that you and your spouse or common law partner can both do. So again, past 65, has to come out of a RRIF versus RSP. If you pull money out of an RSP, it does not qualify for that pension income tax credit. So again, we'll put links below for both the RRIF minimums, kind of a spreadsheet on that, as well as the pension income tax credit and what qualifies for that tax credit. Again, once you hit 65, you want to make sure that you have at least $2,000 of income that qualifies under that tax credit to take advantage of that. So thanks for joining us today. Hopefully that gave you a bit of insight into the RRIF minimum and the pension income tax credit. Again, some of the tips and tricks that we give you, make sure you implement those. You might be leaving money on the table or paying too much in taxes. So we want to reduce both of those as much as we can. Tomorrow we're going to talk about withholding taxes. So where does withholding tax come in? How does it work? What does that all look like? We'll do a full explainer video on that. So again, thanks for joining us today. We hope you enjoyed the video. If you do, hit the thumbs up button. It really does help with the YouTube algorithm, get our videos out to more Canadians. And as we know, more Canadians need to learn about proper retirement and tax planning. And so we do 2 videos every single week on exactly that. So hit the thumbs up, get these videos out to more people. We really do appreciate it. Thanks for joining us today. We'll see you tomorrow.